For over 2 decades, Japan has served as the world's anchor for zero interest rate policy and limitless liquidity, fueling the famed carry trade, where investors borrowed cheap yen to invest in higher-yielding assets abroad, including U.S. treasuries. That era is now fracturing. Japan's 10-year government bond yield has recently spiked to levels not seen since the global financial crisis of 2008. This is a monumental change. As the yield on these safe Japanese assets rises, the incentive for Japanese institutions, which hold a colossal $1 trillion in U.S. Treasury securities, to repatriate funds back home increases exponentially. This potential unwind of the global carry trade represents a tidal shift in the flow of capital. If executed at scale, it would force a violent repricing of assets worldwide, particularly long-duration bonds and speculative risk assets. Cryptocurrencies, as the most speculative and globally traded risk assets, are not insulated from this. They are the proverbial canary in the coal mine, feeling the tremors of this tectonic monetary shift first and most acutely. Therefore, the current crypto crash is more than a sector-specific correction. It is the leading edge of a potential global financial recalibration, where the foundational assumptions of cheap, endless liquidity from the East are being fundamentally questioned. This global context makes the Fed's actions tonight not just a domestic policy decision, but a critical countermove in an international game of monetary strategy. The current market chaos has created a stark battlefield of narratives. On one side, the bulls marshal around a potential central bank rescue, leveraging historical analogies and political optimism. On the other, the bears point to deep-seated systemic risks and alarming statistical trends. The market's next major move will be determined by which of these catalysts proves dominant. For us, as analysts and investors, understanding the exact contours of this battle is not academic. It is the essential guide for navigating the coming volatility. The bull case. The Fed as Deus Ex Machina bullish thesis is a catalyst-driven event, a decisive market-rescuing pivot from the Federal Reserve. This isn't mere hope. It's anchored in a specific historical precedent. In September 2019, when the Fed's previous round of quantitative tightening ended, the S&P 500 proceeded to rally a staggering 17% in just 3 weeks. The argument championed by analysts like Tom Lee is that we could witness a repeat of that liquidity rush phenomenon. The psychology is powerful. The removal of a persistent multi-year headwind, the draining of liquidity via QT can itself be interpreted as a stimulus, encouraging sideline capital to re-enter the market. Furthermore, there is growing talk of potential rate cuts from the Fed, possibly starting as soon as their next meeting. Even a hint of this dovish shift in tonight's statement or press conference could be the spark that ignites a ferocious, short-covering rally. The logic is that fund managers who threw in the towel and de-risked in November would be forced into performance chasing to salvage their annual results, creating a powerful wave of buying before year-end. This potential monetary catalyst is amplified by a political subplot. The spotlight on Kevin Hassett, the reported frontrunner for the Fed chair position, should there be an administration change, provides a longer-term narrative fuel. Hassett's documented pro-innovation and generally pro-crypto stance is seen as a paradigm shift from the current guard's cautious regulatory posture. The market is a discounting mechanism. The mere prospect of a more favorable regulatory and monetary environment under future leadership can begin to put a floor under prices today. This creates a dual-layered bull case. Immediate relief from a Fed pause or pivot, layered over a future promise of structural support for the asset class. The bear case, a tapestry of systemic and statistical risks opposing this optimism, is a formidable array of structural and psychological risks. The bear case is not a single thesis, but a tapestry of interwoven threats that suggest this downturn may be more fundamental than a simple liquidity squeeze. First, we must confront the bellwether crisis, MicroStrategy. The company's stock has not just declined, it has been obliterated, falling from highs above $450 to the $160 range. This isn't just about one company. MicroStrategy has been the de facto public proxy for a Bitcoin conviction trade. Its historic success fueled the narrative that a corporate Bitcoin treasury strategy was not only sound but revolutionary. Its current collapse, therefore, strikes at the heart of that narrative. Critics like Peter Schiff argue the business model is being exposed, alleging the company must now sell stock to fund operations rather than acquire more Bitcoin. Whether fully accurate or not, this perception is a powerful sentiment anchor, creating doubt about the viability of one of crypto's most celebrated institutional adoption stories. Second, we face the perennial specter of stablecoin instability. The latest attestation report from Tether has reignited concerns. Analysis suggests a potential $34 billion shortfall in instant liquidity, meaning if a significant portion of holders demanded redemption at once, the system could buckle. This reveals that the world's largest stablecoin operates on a fractional reserve model uncomfortably reminiscent of the traditional banking system the crypto world seeks to transcend. A loss of confidence in Tether, however remote the probability of a true bank run may seem, is a systemic risk of the highest order, as it would freeze the primary liquidity veins of the entire crypto trading ecosystem. Finally, and perhaps most soberingly, we have the cold, hard weight of statistical history. Market analysis shows that when Bitcoin closes the month of November in the red, the month of December has followed suit a decisive majority of the time. This seasonal trend is a powerful psychological and mechanical force. It discourages new long positions in December and can lead to tax loss harvesting selling, creating a self-fulfilling prophecy. This statistical headwind directly contradicts the hopeful Santa rally narrative and provides bears with a data-driven basis for expecting continued pressure, regardless of Fed rhetoric. The X factor, silent growth amidst the chaos amidst this pitched battle between bull catalysts and bear risks, lies a crucial, often overlooked X factor, the relentless, quiet growth of crypto's utility layer. While price action dominates headlines, adoption and infrastructure continue to evolve. Prediction markets like Polymarket, now officially live in the US, are seeing explosive user growth outpacing established sports betting giants. This isn't speculative trading. It's a demonstration of blockchain's unique utility for creating global trustless markets for information, a real-world use case playing out in real time. Simultaneously, the frontiers of traditional finance continue to blur with crypto. The filing by Bitwise for an Avalanche AVAX ETF that explicitly includes a staking yield component is a watershed moment. It signifies that regulated financial products are now being designed not just to track crypto prices, but to capture its native yield-generating properties. This moves the conversation from "can you own it?" to "how does it work and how can it earn?" This silent structural adoption by the traditional financial apparatus builds a more resilient foundation for the next cycle, even if it does not halt the current sell-off. The verdict, a clash of time horizons. Ultimately, the current battle lines represent a clash of time horizons. The bull case, the Fed pivot, is a short to medium-term liquidity event, a powerful, potentially explosive catalyst that could reverse sentiment rapidly. The bear case, systemic risks, historical trends, is built on longer-term structural and cyclical concerns that question the asset class's immediate stability and seasonal momentum. The X-factor growing utility is a long-term secular trend that operates almost independently of price. As strategic participants in this market, our task is not to blindly choose a side, but to identify which force is governing the tape at any given moment. Is price action responding to Fed commentary and liquidity metrics? Then the play. Are we breaking down on fears about leverage, stablecoins, or following seasonal patterns? Then the bear risks are dominant. Recognizing this allows for a nimble evidence-based approach rather than a dogmatic one, enabling us to navigate the volatility these competing forces are guaranteed to create. We have analyzed the historic pivot, mapped the battlefield of catalysts and risks, and now we arrive at the most critical phase, the action plan. In volatile, binary event-driven markets, analysis without execution is merely commentary. The coming 24-48 hours present a clear high-stakes inflection point, and your success hinges on a disciplined, premeditated strategy. This is not a time for impulsive moves driven by fear or euphoria. It is a time for a measured, process-oriented game plan focused on interpreting signals, defending key levels, and managing your psychological exposure. Phase 1, the signal scan. Tonight, next 24 hours, your immediate priority is to become a disciplined interpreter of central bank communication, not just a chart watcher. The primary catalyst is not a moving average crossover, but language emitted from the Federal Reserve. Your focus must be razor sharp on two specific events: tonight's FOMC statement and Powell's press conference, 8 p.m. AST. This is the main event. You are not just listening for the confirmation that QT has ended. That is the baseline expectation. You are listening for tone and forward guidance. Scrutinize every adjective. Is the economy described as resilient or showing signs of softening? Is inflation elevated or moderating toward target? Most critically, listen for any alteration of phrasing around future policy. A shift from additional policy firming may be appropriate to policy is well positioned, or any discussion of the timing of rate cuts will be the equivalent of a green flare for risk assets. Powell's demeanor in the Q&A is equally crucial. A dovish stumble or a hesitant answer on balance sheet policy can move markets more than the prepared text. The December 10th Fed rate decision. This is the potential confirmation or denial. Tonight sets the narrative. December 10th could deliver the first concrete action, a rate cut, or a firm commitment to a timeline. Your game plan must treat these as a two-act play. A dovish tone tonight without action on December 10th may lead to a sell the news retracement. A hawkish tone tonight would make December 10th a potential crisis point. Mark both in your calendar and plan your analysis and potential position adjustments around. Phase 2. The level defense, the $83,000 line in the sand. While we listen for the fundamental signal, we must simultaneously guard against a technical breakdown. The most critical price level to monitor on the Bitcoin chart is $83,000. This is not a random number. It represents a profound psychological and mechanical threshold. Data indicates that the average cost basis for investors who entered the Bitcoin ETF market this year is now hovering dangerously close to this level. These are not diamond-handed retail holders. They are institutions, hedge funds, and financial advisors operating with stop-loss orders and risk management mandates. If Bitcoin decisively breaks and closes below $83,000, it risks triggering a cascading liquidation event. These ETF investors, now sitting at an unrealized loss, may be forced by their own protocols to cut positions, creating a wave of institutional selling that could accelerate a decline towards $72,000 or lower. Therefore, your second imperative is to watch Bitcoin's interaction with this zone. A forceful rejection and bounce from $83 on high volume following a dovish Fed signal would be a powerfully bullish technical confirmation. A high-volume breakdown below it, regardless of Fed talk, is a clear danger signal that the structural selling pressure is overwhelming any positive narrative. This level is your objective risk gauge. Phase 3. The decision matrix and portfolio posture with the signal scanned and the level monitored. You must execute a predefined decision. This is where you move from passive analyst to active portfolio manager. Avoid the trap of needing to be bullish or bearish. Instead, operate in terms of risk-on or risk-off postures based on the evidence. Scenario, the rescue. The Fed delivers a clearly dovish pivot, tone shift plus hint of cuts, and Bitcoin fiercely defends $83,000. This is a high probability setup for a sustained rally. Your action is to methodically increase exposure, focusing on high beta assets, major altcoin structured products that would outperform in a liquidity surge. Your stop loss for this thesis is a break back below $83. Scenario B, the trap. The Fed is neutral or hawkish, more work to do. Inflation concerns persist, and our Bitcoin slices through $83,000 with conviction. This confirms the bear narrative is in control. Your action is to aggressively de-risk, reduce spot holdings, raise cash, and consider strategic hedges. Your goal here is not to maximize profit, but to preserve capital. The opportunity will be to re-enter at lower levels, such as the $72, $75 zone, which becomes the next major technical and psychological support. Scenario C, the ambiguous grind. The Fed's message is murky and Bitcoin chops around the $83, $86 range. This is the most likely scenario and requires the most discipline. Your action is to do nothing major. Maintain a core, reduce position if you have one, but avoid adding significant new exposure. Ambiguity from the Fed is a policy in itself. It suggests uncertainty, and markets hate uncertainty. In this case, patience is your most valuable asset. Wait for the next clear signal, either from price action breaking the range or from the December 10th meeting. The psychological imperative. Managing you finally. The most underrated part of your 24-hour game plan is managing your own psychology. The volatility will be extreme. Headlines will be screaming. Your portfolio will swing. You must have already decided before the announcements what your scenarios and actions are. Write them down. This pre-commitment removes emotion from the moment of crisis or euphoria. Remember, the goal is not to catch the absolute bottom or top. It is to make a series of rational decisions that compound over time. The signal you are waiting for is not a secret tip or a mystical chart pattern. As we've established, the clearest sign for the next macro trend in crypto will come from the language in a central bank statement. Your job is to listen, interpret, and act with discipline. The chaos is not your enemy. It is the environment in which the prepared mind can identify and seize structural opportunity.